Welcome to Pinnacle, the video newsletter designed to help small businesses reach new heights. Today we're covering 5 tips to help maximize value on the sale of your company. If you're like most business owners thinking about selling, you've spent years growing your successful business, made many sacrifices, and now you want to reap the benefits of all your hard work. Unfortunately, if you are like most business owners, you also have not planned for perhaps the single largest financial transaction of your life. Don't worry. With a few key tips, a little more hard work on your part, and some professional guidance, you can realize your dreams. Tip number 1. Have good financial records. This means both internal financial statements, ideally prepared on a monthly basis, and annual tax returns. Your financial statements show the health of your business over time to potential buyers. Once a buyer is interested in your business, financial statements are typically the first thing they ask for. A seller without orderly financial records will not attract serious buyers. Internal financial statements are typically used to help manage the business, while tax returns are used to report income to the government for tax-paying purposes. These statements may not show the same income based on how they are prepared, for instance, cash or accrual basis, but you will need to be able to reconcile the differences between the two for buyers. Since most business owners do not have the skill or time to prepare financial statements and tax returns, you should invest in a good accountant who can prepare these records for you. Just as important, review your statements with your accountant regularly and don't be afraid to ask questions. Tip number 2. Report all your income on your tax returns. The biggest part of almost any business valuation is based not on the income the business generates, but your ability to show a buyer how much income the company generates. Most business valuations are based on some variation of a multiple of income, and unreported income is unvalued income. If you think a buyer will value your business based on your good word about all the unreported cash it generates, think again. What you are really saying to a potential buyer is, "Trust me, I might be lying to the IRS, but I'm telling you the truth about my income." It's not worth saving 20 cents on taxes to lose $3 or $4 on valuation. Don't trip over dollars to pick up pennies. Tip number 3. Price your company to sell. Pricing your business too high might make you feel good, but it won't help you sell your company or achieve your goals. Worse, it will chase away good buyers who may never return. Know what your company is worth before putting it on the market and have realistic expectations. Most sellers have an inflated value of their business based on their own bias, emotional attachment, and lack of real transactional experience. A good pricing strategy is based on facts and market conditions. Your business is only worth what someone is willing to write a check for. A good business broker or valuation expert can assist you in this area. Tip number 4. Be flexible. Every transaction involves 2 primary components, price and terms. Deal value is the combination of both price and terms. Terms include such things as asset or stock purchase, seller financing, non-competition agreements, and numerous other factors. Your goal is to maximize your deal value. In an effort to be tough negotiators, many sellers have chased away good buyers and an otherwise good deal by setting either a firm price or firm terms too soon. As an example, during discussions with a potential buyer, a seller might let it be known that they will only consider offers that are all cash at closing and that no seller financing is available. Buyer B was ready to offer $1.3 million for the business, $1 million cash at closing, and $300,000 paid over 3 years. Based on their discussions and the firm terms established by Seller A, Buyer B never makes their offer. Seller A later goes on to sell their business to another buyer for $900,000, all cash at closing, just like they wanted. And in the process, they leave $400,000 of total deal value on the table, including an extra $100,000 of cash at closing. To maximize your deal value, remember to be flexible on both your price and terms. Tip 5. Answer questions. From a buyer's perspective, every question is a concern and a reduction in price. You may think the question is unimportant, but then again, you own the business. You are there every day, and things that are obvious to you may not be obvious to a buyer. If you don't have time to answer questions, buyers will not have time to make serious offers. Thanks for listening. We hope you enjoyed this program. Today's content was provided by the Association of Professional Merger and Acquisition Advisors. If you have further questions on the topics presented, please be sure to contact the APMAA sponsoring member who will be happy to assist you.